Our next guest says that 2024 will be a year with more investment options than we've seen in the last 2 years. Anastasia Amoroso is iCapital chief investment strategist. And Anastasia, we look at this year, it's been a pretty phenomenal year. Nobody anticipated that at the beginning of the year. Why do you think it's going to get even better next year?
Well, good morning, Becky. And it's been a phenomenal year if you're invested in the broader equity markets, I emphasize, and also if you're invested in tech stocks. But everything outside of that has not done particularly well. For example, even though we've seen a rally in yields in the last couple of months, the long-term treasuries, for example, are still just roughly breaking even for the year. And if you look outside of the Magnificent Seven, as we well know, there's not really been a broad-based participation. But I do think that's exactly what changes in 2024, is that investors should have greater optionality to invest across different sectors and across different asset classes as well. And Becky, the reason I say that is if the Fed does indeed cut rates and if yields continue to move lower into 2024, then you can have sectors of the equity markets that really got hurt by higher rates. They can turn back around and you can have a lot of catch-up trades in what is lagged in 2023.
What do you like the most?
Well, there's a whole list of things, but I'll share with you in equities. When I look at the laggards, the biggest laggard has been unprofitable tech. And of course, you can put small caps into that category as well. 2023 has been about sticking with what you know, which is the biggest companies. But if you look at unprofitable tech, it is down something like 54% from the highs we saw in 2021. And it has been rallying very significantly in November and December, but there's still a huge gap to close. And again, when I look at smaller companies that were disadvantaged by higher rates, some of them may have been over-levered, some of them may not have had access to financing, but all of that, if that starts to churn, then I think that's a pretty significant catch-up trade. And then, Becky, the other one is real estate. That's really the other thing that people have abandoned throughout 2023, specifically commercial real estate, because everybody assumed that this wall of maturities is upon us and that's going to get pretty, pretty nasty. Now, if rates are, in fact, declining, first of all, that means property prices may be holding out better than expected. And then, of course, the worries about the defaults, may be pushed back or maybe, canceled altogether. So I like those catch-up trades in equities. But Becky, don't forget fixed income, right? If you have yields declining leading up to the first rate cut and after the first rate cut, that means the rally for bonds continues as well. And again, that's why I say it's a broad opportunity set: equities, fixed income, venture capital, real estate, and more.
Here's what I don't get, though. If you think that rates are coming down and that's going to be a good opportunity for some of these areas, let's say small businesses that couldn't get access to capital before, or commercial real estate, doesn't that also imply that the economy is going to be coming down? If you're going to get the rate cuts, it's going to be because the economy is struggling a little bit. And those would be the same types of companies that would struggle in that environment. Well,
I think it's really two or threefold reason for why rates will be coming down. The first one, as you mentioned, yes, the economy should be running at a much slower pace. We're expecting something like 0.6% in the second quarter. But the other reason, of course, is inflation. Inflation should be hitting 2.7% by the second quarter of next year. And the third reason is, yes, you do have rising defaults, which slow the economy as well. So, but all those forces together, yes, slower growth, but also lower inflation, that's what should cause Fed to eventually cut rates. Now, if you apply that to what does this mean for the S&P 500, on the surface, it looks like, well, we're fully valued. We've got a 19 times multiple and $244 or so on the S&P 500 earnings. That gives you right where we are today, 4,700 to 4,800 in fair value on the S&P. But Becky, one thing to remember is that the earnings estimates will shift, and at some point they will take into account 2024 or 2025 rather. And when those earnings estimates shift and the 2025 number for S&P 500 earnings is actually 275, that's what gives you the upside and the further, further momentum for the S&P and this run and the reason to stay in the equity markets. But quick point, to unprofitable tech and small caps. Yes, economy is slower. But if it's still growing and you don't have the concerns about the high cost of capital, I think that's why those catch-up trades can also work.
Yeah, Anastasia, the one thing that makes me a little nervous is last year at this time, everybody was convinced that 2023 was going to be a horrible year, and it turned out to be the opposite. Right now, just about everybody is convinced that these gains can continue in 2024. What would change that scenario? What would be the outlying factor? What would be the unexpected thing that could tip all of those expectations on their head, too?
Right. I mean, at this point, the unexpected thing would be if the Fed once again reneges on the rate cuts that they've penciled in their December forecast meeting. Everything that we've just discussed is really contingent upon the Fed delivering on those rate cuts. If they don't, and if those companies will have to refinance their maturing debts at that higher cost of capital, that certainly does raise more significant problems. You know, first of all, you've got the U.S. government that's going to have to continue to refinance potentially at higher rates. You've got, some of the venture capital companies that have not had access to funding. If the Fed doesn't cut rates, they may continue to be shortchanged. And of course, you've got pockets of, high yield that may have to be refinanced at higher rates as well. So the biggest assumption that I think the bulls are making into 2024 is the Fed does deliver on rate cuts. Of course, if that doesn't materialize, then we have to study history and say markets typically continue to rally after the first rate cut if there's no recession, if there's a soft landing. But markets do deteriorate after the first rate cut if the economy has already slipped into a recession, like 2007, for example. I don't expect that to be the scenario, but that's
just the timing. If they wait too long,
correct,
could be the issue with it.